Welcome, everybody. Feel free to stay muted, be on or off camera as you're comfortable or see fit, but it's nice to have a chance to get together and hear a bit from Mike and our partners at Crucial and how things have gone recently. As always, I'll open and just say quickly and say how grateful we are for your partnership in philanthropy and working together to make a difference for Vermont communities. And in particular, before we dive too far in and hand it over to Mike, I just want to call out and acknowledge and talk a bit for a second about our Vermont investment activity. Some of you may have seen some news recently about a new philanthropic impact tool that we launched in partnership with HULA. But this foundation in community foundations has been a leader in this field for 20 plus years of place-based mission investments with 5% asset allocation from all pooled funds of the community foundation are actively invested in Vermont communities. That has those resources have been a part of downtown revitalization projects over the years in places like Bennington, St. Johnsbury, St. Albans, and Springfield. They've been in affordable housing. They've been in farmland succession and transition and launching a new generation of farmers through the Vermont Land Trust. They've been in fixed income instruments with the Vermont Housing and Finance Agency. So there's doing incredibly important work. We see it as important because so many things that philanthropy is asked to solve for in Vermont communities are downstream of the underlying economic and social context of those communities. So as a philanthropic organization managing assets, we have to be attentive, not just to the work that grant making can do, but the work that mission investing can do. So if you think about it and you step back, when you're making grants, which is the linchpin of our community impact, when you're making grants, you're saying to a community and saying to partners that we see your need. When you're making investments in communities, the message out there, the message that's sent is also that we see your potential. And those two things, when they work together and capital is integrated, we see a incredible potential for impact over the course of years, changing systems and changing conditions in Vermont communities. So thank you for being a partner in that. I want to call out, we have had a footprint in venture activity in that Vermont pool for a long time through our partners with Fresh Tracks, the Flex Cap Fund, which is an innovative partner doing a ton of great work. We also, this past fall, and this is the item that garnered a little bit of news, and if anybody has questions about it, Stacey and her team can field them. We launched the Social Impact Charitable Fund, VCF at HULA, which is an option to allocate charitable funds, DAF investment into a limited partnership with HULA. For those who are not familiar, HULA is a incubator accelerator located on the waterfront in Burlington, revitalizing the Blodgett oven manufacturing plant into that incubator and that activity. They had not opened up their fund to other limited partners. So the only way to participate as a limited partner is through a charitable fund at the VCF. It is a way of levering entrepreneurship, committing to innovation and creation of jobs and entrepreneurial activity in Vermont. And it's a piece of that mission investment activity going forward. So we're excited about it as a platform for making difference in the long-term philanthropic impact that will be generated by that. We're excited to have HULA as a partnership within the context of the Vermont pool. And I just wanted to call that out before we dive into the meat of the discussion today in terms of the public call. And I turn it over to Nancy and Mike. So we're excited about the HULA partnership. Again, thank you to everybody on the call for being partners with the VCF in terms of the impact we can see in Vermont communities. Looking forward. I hope everybody enjoyed the sunshine that is out today and was out this past weekend. Winter is getting shorter. Some of us who are skiers may miss it a little bit, but if it's not going to snow, it might as well be sunny and warm. So,
thanks, Dan. Just want to jump in here and welcome everyone. I appreciate your interest in the VCF and particularly in our investment activities. This is this is always, at least for me, a fun call to hear from Mike, hear some different perspectives on our portfolio and on the economic indicators that are out there. We are going to hear from Mike today a discussion about our 3 investment pools. These are the actively managed pools that provide the options for our philanthropic donors to meet their fund holding goals. And I guess without further ado, I think Mike's gonna, one thing that I've got a little bit of a preview on today's conversation with Mike, and he's gonna talk a little bit about the psychology of what we've been through in the past year and what we may have in store. So I think it'll be an interesting and stimulating conversation. We look forward to your questions. We'd like you to think to hold the questions until the end. We'll leave plenty of time for Q&A at the end. So I am going to turn the program over now to Mike Miller from Crucial Advisors. Thanks, Mike.
Hey, thank you. Thank you, Nancy. Thank you, Dan. And Nancy hit the nail on the head. And Dan used a word which I want to steal from him, which was potential. It's an interesting word when you think about it, because it's something that is out there, and you can actually, as Dan so articulately expressed, have a lot of conviction and confidence in the potential of something, but it's not right here necessarily. You have to use your imagination a little bit. You have to maybe rely on history and rely on knowledge and rely on facts to get yourself there. And the reason that ties into what I want to talk about a little bit is what Nancy just said, which is that when we're in a very difficult capital market environment, what we all end up staring at are the numbers that are in front of us, and we're not necessarily thinking of the potential. And when you expand your horizon a little bit, start to think about the potential, you can get to some very interesting conclusions. And one of the biggest ones is that bad markets are usually really good news for long-term investors. We make decisions, the investment committee does, Dan does, Nancy does, that really are very focused on the long term. You'll hear about that a lot today. And when you take that perspective and you don't get too caught up in the here and now, although we look at it and watch it and worry about it, don't get me wrong, you really have tremendous opportunities. And so it's not fun to go through these periods, but unfortunately, I guess they're both a necessary evil, I suppose, and they're a great example of how you can turn lemonade, make lemonade out of lemons, essentially. So I'm going to share my screen and get right down to business here with you. So many of you have been on these calls before. For those of you who are new, my name is Mike Miller. I'm with Crucial Partners, as described, Chief Investment Officer of the firm. And I've actually had the privilege of working with the Vermont Community Foundation. Crucial is entering its 22nd year, I believe, give or take, something in that neighborhood. But it's been a long time. I'd like to seriously say that I started the foundation when I was 13, but it's clearly not true. But nevertheless, there you go. They weren't hiring 13-year-old investment advisors, much for why. So we go right to the results. This is all through January. So when you look at December numbers, you'll see there were double-digit losses for the year. We're not pretending those didn't happen, but we figured we would all enjoy seeing the more recent numbers since these are in the books as we speak today. And you can see that there are the 3 pools Nancy referred to are shown here. There's the long-term pool, then there's a custom market benchmark. And what that benchmark is, and I'll talk about each of these, it reflects the strategic asset mix of the pool. So if we had just used index funds for every segment of it, what would the results have been if we had just done that? It would have been cheaper, it would have been easier for sure to do it that way. And one of the things you'll see right away, the message, which is we're going to get to quite a bit today, is that for the last really 3 and 5 years in particular, we should have just been in the index. And that's absolutely a fact. And I'll talk about how we think about that. For 10 years and 20 years, the story changes quite a bit. And I'm particularly focused for the moment at the 20-year number, because this is, I think, a very good preview of the future and back to potential, where you see the CPI plus 5% number, which is ultimately why we're here. Everything Dan talked about before isn't really built on whether we beat an index or not. It's built on whether we achieve strong positive returns over time. That's a very essential part of this equation. And you'll note that the benchmark was basically 1% per year behind the CPI plus 5. And that translates to, if you actually do the compounding math, that's in the neighborhood of a 25% destruction. And I use that word very purposely. I know it's a very strong word, but destruction of the purchasing power of assets. And so the foundation's decision to, admittedly tolerate it sometimes, as you see here, some underperformance in pursuit of strong long-term outcomes has really paid off over the last 2 decades. And we expect that, by the way, to continue. And in fact, we'll talk about this a little bit later, but we think the markets unfortunately are not set up today just to provide CPI plus 5 to anybody. Our estimate, which is not in these reports, is about 3.5% is the most you could spend in an index portfolio today. And that's because interest rates are still pretty low, even though they're higher. And unfortunately, indexes are extremely expensive today, despite the fact they're down a little bit. So the next group of lines here is the socially responsible pool, which you can see has actually had a much stronger run over 3, 5, and 10 years compared to the long-term pool. We actually like them both to succeed. That's actually quite important, as you would guess. They're different pools in the sense that the socially responsible pool is a screen pool and is very much focused on screening out objectionable areas. The long-term pool absolutely has ESG factors applied to it. It's not just invest in any old thing. But with that said, they're very different pools and very different structures. And I'll talk about the asset mix a little bit later, but there's one really fits into the more traditional buckets of what an ESG or SRI pool looks like. And then last but not least, the midterm pool, which actually is in index funds almost exclusively, is intended to generate a return that is less volatile than the other pools because it uses a lot more bonds. And obviously, for those of you on the call who are following the markets, you're well aware of the fact that last year was one of the worst years for the bond market in a very long time. And so a lot of the protection that we got from having bonds in the past wasn't there last year, which is why you see this for the 1 year number here, even that pool didn't really do any better than the other two pools. All three of them were down, and they were not too much, but they were down. The good news is interest rates now are higher, and bonds are much more able to provide the protection they've just traditionally provided as going forward. So we're not, I would look at 2022 for the midterm pool in particular as an aberration, and actually back to the potential concept before, a precursor to stronger long-term returns, which will be earned with less risk than the other two pools. So if we turn to the next page, one of the things, so I want to try to back up I like to think sunny optimism, but I don't know if you guys felt that when I was talking about potential before and future returns. So what we were able to do is we took the long-term pool. And we did not take the socially responsible pool. Is its record really in the modern form started in 2010, and there actually haven't been that many big drawdowns that lasted a long time since 2010. So that's why we left it out of this. But everything else we'll be talking about both pools. But since 2002, which is when we started working for the foundation, the long-term pool, we looked at every single time it lost 10% or more of its capital. So that happened in 2022, as you know, it was down more than 10%. That happened 24 times if we go back over this entire 20 plus year period. And then take a look at the table underneath. So all we did is we said, well, let's look at every single one of those 24 times and what happened next. Because this is really important, because the other psychological issue to consider is, for most of us at least, the bear markets, the losses, they're bad enough. But the thing that really gets to us as individuals and human beings is that we all suffer from a psychological flaw, at least from a market perspective, called recency bias, which is we assume naturally that whatever's happening in the here and now will continue. That's the concept of recency bias. And recency bias maybe serves us well from a developmental perspective and from all kinds of other perspectives of human beings. But in a cyclical issue or area like capital markets, it serves us very poorly because we assume that whatever bad things are happening will continue to happen. And if that's not true, then we are very, very much misguided in our investment decision making. So this really proves how untrue it is. So take a look at this table. So essentially, of those 24 times, what happened next? So the median, so these don't do statistics all day, the median is the middle of the distribution. Half the times were better, half the times were worse. But the median outcome 1 year into the future was a 19.5% gain. And you can go across the page, you can see that the median outcome, frankly, for every period except for 10 years was a double-digit gain per year. And that's not what people are thinking. Trust me, when they see a loss, they're thinking, oh my gosh, this is bad. And if they just knew the future, which no one does, of course, then they would feel a lot differently about that loss. But then it gets even more interesting. Look at the second line. The worst case outcome, i.e. nothing was worse than this, was a 5.4% gain. So we have, by my math, about 11 months to go in this year. And when we start measuring these 10% losses that we had last year, we'll see, plus losses, we'll see if the record gets broken. I wouldn't be surprised if it did. We're in a complicated time. But with that said, I think it's just interesting that over all this time, which includes the great financial crisis, which includes Brexit, which includes obviously COVID, and it doesn't include the meltdown of last year. Basically, it's just fascinating to think about it. So that's, by the way, just that's not a typo, the January 31st, 2022 date. The reason we end the analysis there is because we didn't have a year until January 31st, 2022. So every month we pick up another year, we can look at this data, we can update this data. But I think this is just one of those tables that I hope is somewhat reassuring. It's not a guarantee. Unfortunately, there are no laws that govern this thing and make it happen. But I will tell you that the investment committee, Dan, Nancy, and the team, we do everything possible to create this outcome. This is not the outcome the index is generated, by the way. They don't always make back their returns this fast, but the pool does. So we'll talk about that in a minute. So one other point I made earlier, which I want to just address the why behind, is that the long-term pool has underperformed its benchmark. The SR pool has, the socially responsible pool has not. And you can see what we're trying to do here is show you why we care about every time period, but we care about the longer term ones more. And the reason we care about them more is because when we generate premiums that compound over time, it makes a huge difference. So I want to just go back for a second and show you something. So if you look at this slide, oops, sorry. Up 7.7 versus up 6.7 at the top, correct? And then look at this one. Up 341% rounding versus up 266%. That feels very different to all of us, I'm sure. And that's a lot of, that's millions and millions of dollars that the Vermont Community Foundation today has to distribute through grants to all the work and then some that Dan described earlier. And that's what we care about. That's what we wake up in the morning thinking about first and foremost. We try over these shorter periods. Let me tell you this. I didn't explain what this graph is. This takes those returns from before and it compounds them. So before, the numbers you looked at in that table, they're per year. But per year really isn't what we care about. We care about the compounding of capital over time. And that's what you see on this page. And the graph really highlights how important these long-term periods are and why we're so focused on them. And while I don't like it, and I know you don't like it either, I'm sure, we don't like to underperform ever. But we know that, and I'll use a hockey analogy if you don't mind. Wayne Gretzky was a great hockey player because he skated to where the puck was going to be. We try to do the same thing. We try to put the portfolio where we think the world should go. I don't mean geopolitics or macroeconomics. I mean, when you have undervalued securities, they'll be revalued and they'll be valued fairly. That's where the puck goes. The problem with what we do, as opposed to Wayne Gretzky, is Gretzky had a pretty good idea when the puck would get there. We do not. And so we sometimes suffer through these periods where you see the portfolio just not doing what we want it to do exactly, but we're not willing to trade more stability and closeness to the index and then lose that far right-hand column. It's an incredibly important concept. It's a hard thing to live with, I know, but it's the absolutely essential because you have to compound capital. So let's turn our attention to another thing, which is important, which is how consistent are the returns that you see here. There we go. So this is the socially responsible pool's returns, again, from this 2010 period. That's the beginning of the modern era, we call it, of the socially responsible pool. So it's actually getting close to 13 years of history now. And what we measured here was what was its likelihood of beating its index. We'd love to be 100% of the time beating the index, but we think there's a trade-off between, again, what we can actually compound at and trying to be that consistent. Because frankly, at the end of the day, the index does dumb things sometimes. I hate to say that, people love indexes, but sometimes there's silly things going on in the indexes, and we're not willing to do anything silly with your money. So the batting average is what percentage of the time from all these periods. So think about every single 3-year, 5-year, 7-year, 10-year period, advanced monthly from 2010 to 2023. And you can see we have actually a very satisfying outcome here, which is the socially responsible pool is between 85 and 91% of the time it's outperformed its benchmark. And to us, that's really emblematic of a skillful execution by the foundation, because the steady state, we've run this for some non-clients of ours and some, I'm not going to name names obviously, but other portfolios, steady state is about 50-50. I mean, if you really have no skill, it should be about 50% batting average. That's what you should get. So that's why sometimes people look good, but they're not, and sometimes look not so good and they are. But 50-50 is the number. Then look at the median outcome, which is another question to ask, which is, well, okay, beating an index is great, but you need to beat it by a meaningful margin because otherwise, why would you bother? So we were beating it over 10 years by, let's say, 0.5% total. So why bother? It's much better not to take the risk, right? So what this number is, again, these are cumulative again. So not per year, just to be clear. That's why they get bigger as you go across the page. But what you can see here is the cumulative return is 6% above the index. And by the way, you should expect in the socially responsible pool in particular, not the long-term pool, I'll get to that a little bit in a minute, that to grow. And the reason it should grow is we're finding more and more ways to actively manage the socially responsible pool. And so you could argue that because we use some index funds, we still use a lot of index funds in that pool over time that are properly aligned with the foundation's values, to be clear. But because we've done that, we've essentially watered down the active management premiums that you see here. And so it's one of the things that I know that we're very focused on in the committee, is Dan and Nancy as well, which is responsibly moving that forward, which means that we're happy to stay in the index until the right opportunities come along, because we don't want to water down the 6.2 by having mediocre active managers. Just to be clear, we want it to, the only way to water it down is with the index, and that's cheap and easy. The last thing to look at, with the exception of 3 years, you can also see that the skew is quite positive here. So the best outcomes, with the exception of 3 years where they're almost the same, a little bit worse than the worst case, but the good days are better than the bad. That's a really important concept too, when you talk about whether there's been skillful execution or not. So we're very, very proud of this record. And I will tell you, it's getting rougher right now. This pool held up very well last year because a lot of screened pools essentially screen out fossil fuels. They screen a lot of older industries, and they end up being more heavily weighted to technology and healthcare type names. That's just the way these pools tend to work. And this one really was, I think, again, hats off to Dan and the committee, thoughtfully constructed, not to be too strong in that regard, because last year was a disaster for anything growth year, as you probably have seen. So we feel like this was a great situation here, even though last year wasn't a great year for the pool. It was much better than it could have otherwise been. So this is the long-term pool now, same exact analysis. We have more time, so back to 2002. So that gives it an advantage from that perspective. And you can see somewhat similar batting averages, although we get up to that perfect 100% for rolling 10-year periods. I hate to say this because I'd love to say that we're going to keep having that happen, but it's just not going to happen. It's going to come down at some point. And when it does, we'll have a bad month, 2 months, 5 months where the 10-year numbers look as good as you should look. But we're really proud of what we have here today. And the other you can see here is these median outcomes are bigger than you saw in the other pool. Again, that's not because this is a superior pool per se. It's an older pool and has less index funds. So we didn't water ourselves down as much. And so that's created feast and famine at times, though, just to be clear. You can also see the best outcome, worst outcomes are really impressive. No surprise, for 10 years, there are no worst outcomes that are negative because there were no underperforming 10-year periods over this entire period of time. So again, another thing I think that I hope everyone's pleased with, I know we are pleased with, and it's really the best way to report the score, so to speak, of how things are going. I'd say this the day after the Super Bowl. Okay, so let's switch gears. I know this is one of Dan's favorite graphs. There's a good reason for it. This is the thing. So we can talk all day about beating benchmarks. We can talk all day about batting averages and all kinds of statistical stuff. But what we're really here to do is to expand philanthropic capital across the state of Vermont. I mean, it doesn't get much more complicated than that. I wish it was as easy to do as it is to say, but that's the goal. So what we want to do is we want to prove a really important point here, which is that when you invest capital, you can't just think about the returns. You have to think about the returns alongside the volatility and the risks that you're taking, because the long term is dominant, as I mentioned earlier, but not if you take on risk that is inappropriate or is more than you need to do. And risk in this case is a lot of definitions there, but the one we're using here is volatility. So the bouncing around that you get in a portfolio is not irrelevant. So the way we went about proving this is we said, well, let's pretend that $1 million fund showed up at the community foundation at the end of March of 2002. That obviously was picked with the date because it coincides with the start of the track record in the long-term pool. I'm not allowed to say modern era. I don't think it was 20 years ago, but I'll say it in the modern era, in the crucial era with the team here, 2002. Then what we did is we took out 5% per year for spending. And we applied the returns, and we added no new money. Just to be clear, the $1 million showed up on day one, and it never was another gift to the fund again. We took out the money along the way, and then we invested it in 3 portfolios. One was the long-term pool, that's the blue bars. Second was a simple 60-40 index mix with an ACWI. For those who don't spend your days on investing, is the all country world index, so all global stocks. And then 40% in BB, which is used to be called Lehman aggregate. Then it was Barclays aggregate. Now it's Bloomberg aggregate. But that's bonds, basically high quality bonds. And then ACWI, again, the gray bars is just all stocks, essentially. And this came out of a question, by the way, that I don't know if you're on this call today, but someone years ago asked, which is, wouldn't we just be better off if we put the whole thing in stocks and stop wasting your time with all this diversification? That's where this chart was actually created. Every crucial client has seen it because whoever asked that question on this call, thank you very much. This is a wonderful opportunity for us to be able to show something important. So look at the 3 sets of bars. Market value change. That is what is left in the fund as of January 31st, 2023. What is left in the fund on top of the million that was originally contributed. So the fund balance is not 450,000. It's 1,450,000, just to be clear, if you're looking at the blue bar. Now you can see, take a look, the all country world index ended up in the same place, just as good. Again, back to the original theory of the question, which is why are we diversifying like this? So now look at the middle set of bars. So that gives you part of the answer, which is more money was taken out of the VCF long-term pool invested portfolio than the all country world portfolio. Why is that? Because the spending policy uses market value averaging. And if you have a more volatile return stream, it cuts spending at certain periods of time when the markets are struggling mightily for longer periods of time, which does happen. And the 60-40 is about the same. So then you get to the last set of columns. There's going to be a big punchline coming in a minute. You can see that the community foundation long-term pool is significantly superior to either, dramatically superior to the lower returns of the 60-40 because we've had premium returns, as you saw earlier, but also significantly ahead of the all country world index because the returns were earned with less volatility, which preserve the ongoing ability of this fund, hypothetical as it may be, to do and make grants and support the philanthropic purpose that it hypothetically had. If I come up with one that sounds really good to everybody. But that's the point, is that this is a balancing act. And it gets to one more graph, which is really important. A little confusing, I know, but take a look. So all this graph does is it blows up those middle bars and shows you what it looks like over time, year to year to year. So we actually had an unfortunate start, you can see, because we started right at the peak. Well, it wasn't the peak. It was in the midst of the last throes of a long bear market in 2000. That's why the lines all drop in the far left-hand side of the page. And you can also see the line for the long-term pool dropping. That's the blue line, by the way. Excuse me for not defining that. A little bit, not a little bit, dropping in the 08 to 10 period. But most of the time, that blue line is heading north. And when it does dip, it recovers relatively quickly. Put that in contrast, forget the orange line, which is the lower return 60-40 line. It's suffering the whole time. But look at the volatility of the all country world index line. That's the gray line. So it's yet again about to finally get back to where the long-term pool distribution rate or dollars would be out the door right now in 2022, 2023. It really is going through 2023, this graph. But then take a look at how many days there were in the desert, proverbially speaking. That's the red line versus the green line. So the all country world index, which looked like a much better idea until the global financial crisis hit in 2007, 2008, was spending more than the long-term pool was. It probably had a higher fund balance at the time. I didn't really look to see, but I bet it did. But then look what happened. It didn't get back to where the spending was in 2008 until 2020. And I don't think I need to tell anyone on this call that that is clearly not the goal of any philanthropist, which is to just start cutting away for 10 to 12 years and therefore destroy the work that is dependent probably in many cases on your ongoing support. But the green line shows you what the long-term pool's worst case scenario was, which was $1 million. We don't love it, 4 years or so, where the pool took the pool to catch back up. But we think actually it's certainly a much better outcome, clearly, and one that we're actually thinking that today we have the portfolio more strongly positioned to mitigate against because it's more diversified than it was even back then. So very, very important. So this is the kind of the hard part of any simplistic analysis of which is better, which is worse. But this is something we think about a lot, which is why we get to the next page and we talk about our strategy, which is intended to make sure that we have growth of philanthropic capital, even when it's not easy to do so, even when the crowd is doing something that's different than what we think will work. And there are 3 basic principles. Rule 1, we think long-term. So today, the investment committee is going to be talking about the strategic mix of the portfolios, which I'll show you in a minute. I can assure you, I mean, somebody might try, but I'm pretty sure no one's going to try to guess where the S&P will be at the end of this year. No one's going to try to figure out how many more Fed increases there will be, where interest rates will go, all these things. And the reason we're not going to try isn't because it doesn't matter. It definitely matters. The problem is that we don't know and we have no edge. And if we don't have an edge, then we can make big mistakes and we have no tolerance for big permanent mistakes. We can take a little underperformance because the market doesn't like something we're doing temporarily, but really making a huge decision that we have no advantage on is a huge, huge disservice to everyone on this call and others. Second point is related. I just said it, no attempt to market time or change strategy based on anything near term. And last but not least, diversify. I will tell you, I'm going to kind of get to a big point I want everyone to hear today as many times as I can say it, I will. There are 2 major goals that I have, at least, and I think the Community Foundation has 2 for this call. The first is for everyone to have a greater understanding of the strategy being used and hopefully confidence that a strategy being used is quite prudent and is able to generate the returns that are necessary to support your philanthropic goals. The second thing, which is a little bit more maybe my personal one, but I'm sure the foundation won't object. I would like everyone on this call to walk out of here and ask yourselves the question, are my personal assets diversified as much as they should be? And I'll give you a very specific concern that is behind that comment, which is that a lot of people today are really asking themselves a very simple question, which is when should I go back into tech stocks? Or when should I buy the big growth stocks that were so good to me for 10 years and now have been a little bit ugly for the last year or so? And my answer is, I don't know the answer to that question, I'm afraid. But I will tell you this, maybe the other question to ask yourselves is maybe when should I buy a small cap value stock? Or maybe when should I buy a European index or a Japanese company or anything else around the world that's a little different than just Amazon or Apple or whoever else you have in a large growth portfolio? This idea of diversification is incredibly powerful. People have won Nobel Prizes for it. And yet as investors, we ignore it all the time because we really enjoy the stuff that's working and we really don't like the stuff that's not working. And we particularly don't like it when it takes years and years for it to work. But patience, 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 and diversification are your friends. Always, always, always. It never fails if you pick good companies or good indexes, just to be clear. So I'll give off my soapbox for a second. You're going to hear that again. I'm sorry, one more time. I just can't tell you how important it is. And I really wish everybody would just totally embrace it. This page shows you the strategic mixes. Now, they may be changing this afternoon, but they didn't change yet. So here they are. Next time I see you, we will update you, of course, if there have been any changes to the mixes. But what you can see here is a few things. So first of all, the top set of lines, these are public equity strategies. So we are essentially, this is where we own the stock market, essentially. And here you can see the subtle differences between the socially responsible pool and the long-term pool. They have similar equity exposures. The midterm pool has less equity exposure because it's supposed to be more defensive. Again, last year was a little bit of a challenge there. If you look at the bond piece, which is the middle set of bars above the second kind of maroon colored, rust colored shaded area, a lot more in bonds in the midterm pool. That's again, shorter horizon. We want a less volatile pool. I've already said it too many times, but 2022 was a weird year. Don't expect that. I'm not worried about another 2022 for a long time, just to be clear. I think we'll be fine with that. But what you can see here is particularly the long-term pool and the alternatives are at the bottom. The long-term pool and the socially responsible pool have very heavy equity alternatives exposures in concert with one another. All the pools, as Dan said, this is where the foundation's been a trailblazer, have 5% Vermont investments. That remains a trailblazing idea, by the way, 20 years later. And it's very interesting to think about that too. But my point is that what you can see here is that these are very long-term oriented pools, which is why, especially the first tool, which is why we're not focused on short-term results that much. This is meant to drive those long-term outcomes you saw earlier. Two more quick points. Special opportunities, for those of you who don't actually know what that means, because it's kind of our term and the foundation's term, that's a reference to global equity strategies that are very niche oriented. So we have, for example, a Japanese activist in that group that buys companies and tries to fix them in Japan. So very, very specialized niche strategies which go in that category. So that's why we called it out. In the long-term pool, we don't use those types of strategies currently. In the socially responsible pool, I would not rule it out down the road. And if you look, last thing I want to tell you, these numbers, when the committee meets today, they don't change that much. Watching, and I'll say this just for Crucial, not for the foundation, but watching us change the strategic asset mix is like watching grass grow. We're not going to move quickly. This year, it's interesting to talk about the movement because so much did change in the capital markets, but the only thing that drives us to change this mix is a change in capital market conditions. You have interest rates are 3% higher than today. The stock market was 50% higher, 50% lower than today. That would create bigger moves. But in a world like even last year, it doesn't generate huge swings in what we do. So you should not expect anything particularly breathtakingly different when you see this next time. So one of the things I want to just spend a few minutes on, and we'll get to the climate briefly today, is talk about a little bit about the research effort. Because I mentioned active management a few times. I showed you the success rates and the high hit rates of the portfolios, both pools over time. I just want to give you a quick, probably 30 seconds on what a crucial analyst's life is like and when they're taught. We have 17 people whose job it is to go find these managers. I'm chief investment officer, I mentioned earlier, which means I oversee it. I love that part of our work. So I spend a ton of time on the road with the analyst, meeting with every investor as well. I can't stop myself. It's great. Probably should be doing something different, but I can't. So there are certain rules that we teach everyone. Rule one, returns are always accompanied by risk. We're not in the business of trying to eliminate risk in portfolios. We do moderate with diversification, like I said earlier, but risk is part of investing. And the critical questions to ask yourselves are not, how do I get rid of risk? It's, what risks am I taking? And do I think I'm going to get paid to take them? I think that's a really important concept that we spend all our time thinking about with the investments that get made. The related rule is, think about what can go wrong. What is the worst case scenario? Because, by the way, it'll happen in this kind of stuff. So if it does happen and it's deadly, then you can't do it. So there are certain risks that you never take because you can't live with them. And the rest of the ones that you do take, you diversify them, but you also do that because you think you'll get paid to take them. And most of the time that works. Second bullet point, one of the ways you assess risk, part of the risk is what people invest in, and part of the risks are the people themselves. And that's why I will tell you, COVID was, for all of us, just a horrible human tragedy on so many levels. And I'm not at all putting this above that, but for at least from a professional standpoint and our obligation to all of you, the inability to travel and look people in the eye at a room, at a conference table, wherever we were sitting, was a huge problem. We made it work and didn't have any problems that really translated to the real world. But the fact is, we needed to stop that as soon as possible. And thank goodness we have. So the crucial travel budget is back to its pre-COVID levels, I'm glad to say. And thank goodness, because we are able to do our job so much better. And you should have some, hopefully, additional comfort that everything is being vetted even more than it was certainly more than it was during COVID. Operational issues. This is a place where we cannot take risk. There's no risk of operations. So obviously, Nancy has a wonderful team at the foundation. We have a team that looks at these things, including outside counsel and their documents, but also we have what we call an operational due diligence team. And their job is to make sure that there are no Bernie Madoffs in this portfolio. And that's why we've never had one, just to be clear. So that's very important. And then last but not least, this is a forward-looking process. The reason that active management doesn't really work 90% of the time, if you ask us, isn't because active management is such an abject failure. I mean, there's certainly some of that, but it's mostly because people allocate poorly. They pick a manager with a really strong track record. That manager then has a couple, 2 or 3 or 4 bad years, and they fire them and they go on to the next manager with a great record. And they lose the benefit of capitalizing on cyclicality, not being at its mercy. So it has to be forward-looking. So managers with bad track records are viewed just as interesting, just as strengthily. They're viewed and assessed, just as robustly as managers with good track records. They're both the same thing as far as we're concerned, which is, what are you going to do for the next? And did you do anything in the past that makes you unqualified for this portfolio? Then you're going, and it could be a good result or a bad result, by the way. People take on excessive risk. Just the fact that it works doesn't make it good. They got lucky, and we're not doing luck here. We're doing skill and diversification. I'll skip by this. This is just again, back to, if you ever thought about wanting to work at Crucial, this is not even a whole list of stuff that our analysts look at, and there's a bunch more, so I'll keep moving. So let's talk about the climate. And again, I mentioned those 2 things I want you to remember. And the second one, i.e. diversification, radical shift in investment climate. I don't think people fully appreciate what's happening here, which is that after really 13 years of the Federal Reserve and other central banks around the world handing out money to almost anyone with a pulse, and particularly to promotional CEO types, promotional shareholders, if there are such a thing, that is over. And I don't think it's coming back. Let's hope it doesn't, because it created a lot of problems in our society, by the way, and a lot of things with misallocation of capital, which we've been seeing. So there's a radical shift underway towards actually what we think is more normal, which is maybe more normal economic cycles. Federal Reserve is in a very tricky spot right now in terms of what they're going to do. They are actually, no matter how many times they say otherwise, they really kind of need to drive our economy into a recession, because that's how you really beat down inflation in a meaningful, lasting way. It's an ugly thought, and I'm not at all dismissing the human toll it takes. But I think our policymakers have made a decision, which does seem prudent, which is that bursting a bubble in Bitcoin is far less of an evil than having sustained inflation, because sustained inflation really hurts the average person in this country and in the world. So this shift is not temporary. We're not going back to 2019. So it's dangerous then, if you think about it that way, to take what was working for you before this shift and think it will work again. And that's back to my, when do I go back into tech stocks question from before. Tech stocks were the one decision thing for the last 10 years, but maybe the future will be different. I want to suggest that we know for sure, but we think we have a pretty good idea. And I am a huge fan of taking lessons of history and letting them help us. And history is very clear what happens, which is that last bullet point. markets tend to change following volatile periods. People just need to really remember that. It's incredibly important. Nobody should have gone back into bank stocks after 2008. And I think the same story is going to hold for tech stocks today. They're a little more complicated. They're less complicated than banks in some ways. My point is things change. And then a third bullet point, which we don't offer a proof statement today, but I'm happy to in the future. Unfortunately, the bad news is the big cap stocks at the top of these indexes, they are expensive. And the bad news is they will be reasonably priced, in some cases 50 to 60% below the current prices. And that's after last year's 15, 20, 25% declines on some of them. So that's the problem with an overvalued security is it takes a lot to get it back down to fair value. And so, there's a lot of ways this can play out. But my point would be, we could be wrong about valuation on these core growth indices, but we're probably not, just to be clear, because really, the evidence is extremely strong. But even if we're wrong, you shouldn't have all your eggs in that basket. That's the key point. So just a couple quick pictures, which are fun to look at. This is why the market had such a tough time last year. This is why the bonds didn't protect the medium-term pools we would have hoped. And this picture shows you basically how many trading days and how much interest rates were increased by the Fed over these last 5 cycles. And the 2022, which by the way, has not yet been updated for, I think it might've been 2 weeks ago now, I'm losing my weeks, but 10 days or so ago, the Fed increased rates again. That's not even on this graph yet. But this has been one of the quickest and sharpest increases in interest rates that the Fed's done in a long time. My next project is to ask, this is from Baird, as you can see, but I asked them to add some of the 1970s, 1980s increases to this. I think that'll be fun to look at that too, but we don't have that data. But again, I feel comfortable saying that if you're looking back to the mid-90s, this is a long period of time. It gives you a sense of how unusual this change was and how strong it was, frankly. Which gets to another thing. So one more fallacy, which I'd love to try to help correct, is there are a lot of people who will invest capital with the following idea in mind, which is, let me think about where in the world the economy is the best and where are things the most calm and easy for me to kind of feel comfortable with. And by the way, if you really want to get good investment returns, you need to give up comfort. Comfort's not really part of the equation, unfortunately. You just have to live with the discomfort. But what I would tell you is that that's the philosophy. And what that would lead to, let's use the obvious example on this page. So this chart shows you different geographies around the world. These are the equity returns of those markets in 2022. The far right-hand column is what did they return in local currency, which means if you owned Europe, euros and pounds, for example. The second column in the middle, that's what happened if you owned the dollar, if you're a US investor like the foundation is. And so the foundation doesn't just, when it invests outside the US, which it does, it gets the stock price changes of those securities plus the currency. So if the dollar gets stronger, which is what happened last year, then you lose money because we owned euros and pounds. So that's why negative 8.5% becomes negative 15.1%. But here's the real point, which is Europe. Anybody want to make the case why Europe is a comfortable and safe place to invest right now? I mean, I think it's pretty obvious the opposite is true. We have a horrible war that started in March, as you know, of last year going on there. Whatever Brexit is doing is still doing its thing over there too. Plus you have a lot of dysfunctional governments and economies over there. You got plenty of things that I think a rational person, I love Europe personally, but you could certainly make a rational economic argument that it is not as good as the US in any way, shape, or form, nor is it as safe. But look at the return in local currency, down 8.5%. It was a wonderful place to preserve capital. Right underneath it, Japan, only down 4.5% last year. Japan's hardly got no problems, especially it sits right over there in Asia, near China, and all the other geopolitical issues going on there. Yet the reason this can happen is because the person who says, I want to invest in a safe place is missing an important thing, which is what's in the price in those places. So if Europe was priced for everything to be great, it would be a terrible place to invest. But Europe is priced and Japan is priced as a really bad things are going to happen. And when it's just a little bit better than bad, those markets can do better than ours, which is what you see here at the top. So very interesting to think about that, which I want to leave with one more picture. And it's a little technical, but I'm going to really boil it down into something that's not too technical. This is what we call purchasing power parity. And what it means in English is that currencies should basically buy the same goods and services no matter where you are in the world. This line is showing, this graph is showing you what the dollar's valuation looks like compared to other currencies around the world. And when the line is really low, like is on the far right-hand side of the page, it means the dollar's grossly overvalued against the yen, the pound, and the euro. Those are the main currencies that are in this graph. And another way to think about this is sometimes, I always get this wrong, I think it was Economist created the Big Mac Index. And the Big Mac Index, very simply put, for those of you who like McDonald's, tells you that you should be able to buy a Big Mac in Burlington, in Tokyo, and in London or Paris or wherever you are in the world for the same price. And the reality is that right now, until recently, you could buy a Big Mac in Japan for about 50 cents on the dollar. I was mentioning before the call started, I was in Brazil a few weeks ago. You could buy a Big Mac in Brazil for like 35 cents on the dollar. So what that's telling you is that the currencies are out of whack with one another. So one more quick point. You see how we lost money more than we would have because we had the dollar? That was basically this graph heading to the right here is what you see here, the dollar getting more and more and more expensive. The beautiful thing about this picture, though, if you look at it really carefully, is first, this is extreme. This is all the way back to the 80s. The dollar has not been this overvalued for basically about 40 years. The second thing, it's a cycle. Everything's a cycle. So we actually know exactly where this puck is going. The problem is that could be 2 years from now before the puck goes to where it's going to go, or it could be happening as we speak. It's starting to change a little bit. So my point is that this is what we rely on as investors, is that this actually tells us exactly what's going to happen in the future. The only thing it doesn't tell us is when. And so we have to live with that inconsistency. We have to live with that uncertainty. And then what we do is we diversify these risks. So I will assure you there will never be a call where I or anyone else will say, well, the portfolio had a really rough year because we put all our money in the yen and the euro and the pound. We don't do those kinds of things. We're very, very, very cautious and prudent with your capital, we guess, but we lean into these areas where we know exactly where the puck is going. So strict adherence to a strategy that relies on decisions with a high probability of success. It's not a question whether the dollar is going to fall. It's going to fall. The question is, when is it going to fall and how much is it going to fall? Second point, the beautiful thing now is the Community Foundation has a really robustly sized socially responsible pool and a robustly sized long-term pool, which lets us do all kinds of things that scale and stability really pretend. So we can't create these portfolios in smaller pots. So this combining of all of your assets is so important. And then last but not least, over long periods of time, intelligently accepting volatility. That's the, wow, this is uncomfortable. This is not fun. We don't like showing you losses. We don't like hurting the philanthropic impact that your funds have right now in the here and now, but we are willing to do it because we want those long-term returns, which I know you want as well. Here's a quick Crucial Partners commercial. We've been around a long time. I've been at the firm since 1986, and I'll stop there. So thank you. I'd be happy to answer any questions. And Nancy, are you the MC here? Or we have another plan?
Yeah, I can moderate, or Dan can, or people can just raise their hands. Take a look at anybody.
Mike, why don't you stop sharing?
I can do that.
So we can see everybody.
Or
Did you see a quick
left it up if anybody has questions from it.
Yeah, there's a question in the chat about the 2022 numbers. Fourth quarter numbers are being posted on our website. I won't say literally as I speak, but pretty much. We have them, and they're going to be posted. Mike, you did such a great job. No questions.
I
don't see any. Either that, or we're all thinking about your question about our personal assets being properly diversified, and everybody's gone to work on that question.
Yeah, work hard on it, please. I really, really think it's important. And you can use indexes. There's lots of things. You don't have to become a stock guru if you don't want to be one, or if you're not one. But there are ways to do this that don't involve. The S&P is not the only index out there, I think is what I'm trying to say.
Question?
Yes, sir.
Can you give us a little idea of what's on the private equity side, what you're doing?
Yeah, that's a great question. There's a variety of strategies being used. So it's a very broadly based portfolio, everything from real estate oriented funds to venture capital funds to buyout oriented funds. So we've been it's a very expansive portfolio to answer your question. It's had phenomenal returns over time, which is basically everybody's had phenomenal returns in that space, especially in the venture and the growth equity space. One of the things we're really excited about is that we've actually had a lot of realizations. So those numbers are more real than some other people might see. And we don't, let's say this the right way. We don't like popularity. that's the right way to say that. But what I'm saying to you is like, when we see everybody telling us that this is a great idea and I should go do this and everyone should do the same thing, we immediately pull in our horns, and the committee does too, by the way, and say, So that the point I'm getting to is that unfortunately a lot of money has been and will be lost in late stage growth equity investing over the last few years. I mean, some of that money, some of it, we've all read the famous stories, things like great investors like even Sequoia Capital, basically blowing tons of money and buying FTX that's worthless. So the foundation doesn't have that kind of exposure. We really pulled in our horns a few years ago because we don't like bubbles. And it's one of those things that no one ever says is a bubble at the time, but you can really feel them, which is, again, everybody. And there were some really clear slides on this one, which I won't torture you with. But long-winded way of saying that the returns have been really good. It's a very diversified portfolio, and there will be absolutely it'll have the same challenges other investments have from time to time. But we're not. There's no. I don't know if your question is meant to imply, but I know it's in my head all the time. There's not some other shoe going to drop. We're going to have these huge losses that no one's seeing right now because the managers, as I think your question, I know you know this. They don't always have. They're not required to price things the way public markets do. And so you get very, very disparate valuations from time to time.
I think my question really is, so much money has come into this area, it makes me nervous. So that's why I was curious if you were increasing it, decreasing it, whatever.
We're being more skeptical, I think is the right way to say. So it's an extremely good point. Too much money. That was one of the signs of the bubble, by the way. And the related sign of the bubble was, we literally had managers raising huge funds who would call us up and who we'd known for years and would say, hey, we're raising another, $800 million fund. You've got 4 weeks to make a decision. And we're like, what? We need 4 months to make a decision for starters. And that was just a sign of the times, which is that it was so easy. Everyone was just throwing money at these people, which is exactly the point you're making. That was one of those warning signs. So our instincts are to back away and say, you know what, we'll wait. We're not going to throw, so I'm not going to throw your money in a 4-week due diligence process. That would be awful.
Thanks.
You're welcome.
Mike, there's a question in the chat concerning the portfolio. Is it all US dollar invested, or is there any exposure to foreign currency, any foreign denominated investments?
Yeah, no, there most certainly are foreign denominated investments. I'm going to give you the exact numbers because I like precision. Hang on a second. We track this. So the committee sees a very detailed report, which I'm just bringing up on my screen here, which gives them all of this because it's a critical question and one that everyone's focused on. So here's the answer. So right now, the portfolio is 75% allocated to US dollar denominated investments and 25% to foreign currencies, which are a broad group of them, but it's pretty heavily euro, pound, yen, just to be clear what that is. But there are some other currencies in there too. So it's 75% US, 25% non-US.
How do you invest ethically in private equity?
That's a great question. Well, there's two or three things. One's a little bit kind of down the road, but I'm going to describe it because I think it's important for everyone to understand how we're thinking and how we're also evolving. But let me give you the easy part of the answer, which is that we can see something unethical when we see it. So, for example, if a strategy, there was a strategy years ago that we saw that basically it was buying life insurance policies from sick or elderly people, and clearly the managers incentivized to pay abusively low prices and basically take advantage of someone's desperation. So we would never ever touch a strategy like that or recommend it to anybody. That's an easy one. There are other related easy ones where you just see that the strategy is almost by default de facto abusive to somebody. We prefer the world where private equity is, it doesn't always work this way, I understand, but where there's two, hopefully both no desperate parties at the table, and two equally knowledgeable parties at the table, so no one's taking advantage of anybody. So that's just the way you avoid the really egregious stuff. But then the word ethically is obviously a very challenging word, and everyone might have a different definition exactly of what that looks like. So what we're doing is we're increasingly at Crucial spending time on what exactly are people investing in, what exactly are the impacts of some of these funds. This is something we're working on. So it's not something we've been doing to the level I'd like to do in the future, but that we will do in the future. But it's a very interesting question. So it's something that continues to come up, and it comes up around every investment, frankly.
Yeah, I mean, the thing I would add to that, Kate, thank you for the question. You know, this is where the foundation and our fund holders really benefit from the depth of the investment committee, because those are the kinds of questions that come from the investment committee when Crucial brings an advisor to us. So, you know, Tammy Newmark, who's now on the board of directors, and you know, serves on the investment committee, has a really strong set of values associated with the role of private equity. I can point to a number of times the committee has steered away from private equity managers because of, you know, they peel back their strategy and they're looking at distressed assets in communities that look and feel like a lot like rural communities in Vermont. And we're not comfortable with the power dynamics associated with that private equity investment in the communities at which they're at play. So it is, you know, why we benefit and how we benefit from having sort of a multi-pronged assessment approach in the selection of managers. So we steer away from it where we feel like, as Mike said, there is an imbalance related to the communities that the investments are active in, and we can identify as such within the analysis that's provided.
Yeah, really well said. Thank you, Dan. That's an extremely good. I'm actually a little nervous with the committee because I think they have even a tougher lens than we do. I know they do, in fact, and so it's great when we get their feedback. The other thing we do, by the way, just to flip the question on its ear, the foundation's made investments in areas that really clearly have a positive impact. You know, we have a manager that is investing in all kinds of technologies and companies that are trying to solve climate change problems and issues in the world. So you can also flip it the other way. Investments in Vermont that are private, some of them clearly are intended to really improve the lives of those in Vermont. So you can do it the other way, but your question's great, and Dan made a fabulous point, which is you can't just do the good stuff and not worry about everything else. You have to do them both, right?
Mike, this might be a good opportunity for you to reference the letter that your CEO recently sent concerning the investment that Crucial has made in the ESG space.
Yeah, absolutely. Happy to. So we are, I was referring to this very vaguely a minute ago. We are building a brand new, currently public markets tool that uses raw data from providers of data around diversity, equity, inclusion, around climate change, and around energy transition to score every public company that the foundation owns, and then roll that up so we can look at by manager, how people are doing, how the portfolio is doing, and we're dangerously close to actually showing this to somebody. Dan has not seen it, nor has Nancy, but I've seen it. It's almost ready for prime time. And that's what we're working on right now, which is what Nancy's referring to. And the next step of that process, which will be harder, admittedly, is to apply that as well to private companies. The reason it'll be harder is we can't just buy that data. We have to collect that data ourselves somehow. So we're going to learn with the public companies, I hope, and then apply this to the entire asset base. So that ethical question will be one that we have even more data and hopefully facts to support these answers.
Thanks, Mike.
Thank you.
I think we're about at time, so I'm going to turn it over to Dan to send us on our way.
Well, as always, don't hesitate to reach out with follow-up questions through your philanthropic advisor or through Nancy or I. Thanks, Mike, for walking us through this quarterly report. Stay tuned for the Q4 financials, the Q4 performance to go up soon. And, you know, again, thank you for being partners of the Vermont Community Foundation and partners in our impact in Vermont communities, making a difference every day. So nice to see you all. And thank you for all you do.